This is Exchange Traded Fridays brought to you by ETF.com. I'm Sumit Roy, Senior Analyst here at ETF.com, and we have a very exciting episode for you all today. Believe it or not, it's been exactly 1 year since the SEC approved spot Bitcoin ETFs for trading in the US. And in that time frame, they've broken all sorts of ETF records and grown into a massive asset class. We're going to be talking about what we've seen over the past year in the spot Bitcoin ETF space. There's obviously a lot to discuss there, but that's not all we're going to be talking about. We're also going to be discussing bond ETFs. You might have noticed that yields on bonds have been rising pretty rapidly. What does that mean for ETF investors? We're going to be answering that question and more. And finally, we'll touch on buffer ETFs and whether they make sense in the current market environment. As you might have noticed, the S&P 500 has been a little bit rocky over the past couple of weeks. So this is a very, very important and interesting topic. So without further ado, let's jump into it. As usual, joining me today are my wonderful colleagues. We got Wealth Management Editor Jeff Benjamin, Research Lead Kent Tooney, Contributing Editor Ron Day, and myself. What's up, guys? How you all doing?
Hey, Sumit, glad to be here.
Doing great.
Hey, Sumit, Happy New Year.
Happy New Year, guys. All right, so we have to start with the 1 year anniversary of spot Bitcoin ETFs. This is one of the biggest ETF stories of not just 2024, but the entire history of ETFs, period. And I mean, it wasn't easy to get to this point, to even get spot Bitcoin ETFs approved. It's easy to forget now, but this was a 10-year journey that we went on to get spot Bitcoin ETFs finally trading in the US. I remember being at ETF.com in the early days and seeing that first spot Bitcoin ETF filing, the Winklevoss spot Bitcoin ETF. That was back in 2013, and Bitcoin was only $90. Today, it's 1,000 times more valuable. Absolutely incredible gains. But I'm kind of digressing a little bit. I want to talk about what's happened since the approval, exactly 1 year ago. What have we seen since then? After that, we can talk about some of the, inflows and some of the price performance and things like that. But before we get there, Ron, I want to start by asking you a question. You've been covering financial markets for a very long time. What's your take on the past year in which we've had spot Bitcoin ETFs?
It's funny, Sumit. Before jumping into that, I keep recalling day one when the actual announcement, the whole kickoff of this massive industry started off with a failed announcement, right? The SEC put out a statement that was incorrect, and everybody's like kind of jumping the gun, and it proved. Then they withdrew it, and I forget the number of hours. Maybe it was a full day before the accurate statement came out, but it was really kind of a crazy start.
Well, the SEC didn't put that
people
out.
Thought
that
we got hacked or something.
Yeah,
or the SEC
that
got
was
hacked.
that was a hack.
Yeah.
Right.
Okay, right. Yes, you're correct. I mean, a lot of water under the bridge since then. It's been a wild year. I mean, it was kind of, again, a glitch to kick off what has been the most, you see people writing, it's the most successful, like, sector launch, or actually IBIT, the BlackRock fund, has been the most successful launch of an ETF, accumulated assets faster than any ETF in history. So I was talking to Rick Edelman yesterday, and he just said it has been the wildly successful. Brian Armour at Morningstar pretty much said, smashing success. What do we have? 60 billion of inflows just into IBIT. And now then that led to the Ether ETFs launching in June. Clearly not as successful a launch. Still, the industry is just kind of Bitcoin ETFs really at their beginning stages, right?
Yeah.
We're talking this year about a lot of new things possibly hitting the market once Donald Trump comes into office.
Yeah. And just to give you the numbers. It's $38 billion of inflows for IBIT over the past year. But, when you combine that with the appreciation we've seen in Bitcoin prices, the AUM in IBIT, assets under management, are currently $53 billion. And this was the fastest ETF to reach $50 billion, way faster than any other ETF ever. So huge records being broken across the board in the ETF space.
Yeah. I mean, I think there's still, we still have some companies that have not jumped into it, right? Vanguard, most notably,
Yeah.
is not jumping in, but that could change with Ramji as their new CEO, who helped create IBIT.
Yeah, that'll be something. Will Vanguard capitulate it? As far as I'm aware, you can't even trade spot Bitcoin ETFs on the Vanguard platform. At least that was initially you couldn't trade it. Jeff, do you know, is that still the case?
that is still the case. You cannot. Vanguard has a full stiff arm on crypto ETFs. That is something that we will be closely watching. Obviously, it's a huge platform. You're right. Ramji coming on would be the only thing that could move that in a different direction. It's hard to say if that will happen. Seems like they've got bigger fish to fry over there right now. They've got a lot going on, but it's it is a standout. I know there's still some wirehouses that make financial advisors jump through a few hoops, and financial advisors in general are still not wholly on board here. They're treating this as like satellite positions if clients are really begging and kind of clawing for it. But financial advisors in general have not embraced crypto.
Even without that, it's kind of incredible the numbers we're seeing. We talked about IBIT has $50 billion, over $50 billion, but that's only half of the total AUM in the category. There's $119 billion, something like that, in these ETFs. Mm-hmm. And we have the Fidelity ETF has $19 billion. And let's not forget about GBTC, the original kind of Bitcoin fund, which was actually kind of this quasi closed-end fund, and it converted into an ETF. And, kind of the whole industry has Grayscale to thank, right? They set off that lawsuit against the SEC. And when the SEC lost, that's when we finally got these ETFs. And GBTC still has $19 billion in AUM, even though that ETF had over $20 billion of outflows last year, which is just an insane amount of outflows. But it's still the third largest spot Bitcoin ETF. Sorry, Ron, you're going to say something?
Just about GBTC, and one of the lessons learned was about fees, right? Everybody piled into fees and marketing. Everybody piled into BlackRock. GBTC had the massive fees that really kind of killed things, or I shouldn't say killed. They still have $20 billion, but it really hurt them.
Yeah, no, that's a great point, because you think, okay, crypto, it's this volatile asset. People see huge upside. Maybe fees don't matter as much, right? What's 1% when Bitcoin is doubling and tripling? But even in this space, investors cared about the fees, right? The lower fee ETFs ultimately won out. And I think that in and of itself is a story. We could talk about, obviously we have talked about single stock ETFs. Their fees are on the higher end, 1.5% per year, something like that. We haven't seen them touched by the fee war quite yet. But crypto, the fee war was very much alive and well. So
yeah, for sure.
Ken, I'm curious, you're obviously an advisor. Jeff talked about we haven't seen wide scale, adoption of crypto ETFs by advisors. What are you seeing on your end?
Yeah, I was just thinking the same thing. We're about to just say that Jeff's correct, that a lot of advisors are not really, they're not jumping into it. Now, I will say for my clients, I do have some of my younger clients, you could say young Gen X or older millennials that follow crypto. They were really wanting to get into it a couple of years ago when I was like, okay, we're not gonna buy a cryptocurrency right now. But yeah, I do have a couple of clients that were very interested and they want to get in on the launch of the ETFs. So I do have a couple of clients now. It's not even a suitable investment if we're trying to meet the suitability standard, meaning it's a high risk investment to say the least. So, a retired client, it's not even a good recommendation for them, even if they were thinking about it or asking about it. But you're right, and Jeff's assessment is correct. He talks to a lot of advisors, generally staying away from it, except for some of the clients who really understand it and want it, and even then explaining to them the risks and the allocation is going to be 5% or less. So, yeah.
So we'll see what happens, over the next year. Obviously, very strong first year for spot Bitcoin ETFs, $40 billion of inflows or whatever it's going to end up being. Huge amount. We'll see if that accelerates, over the next year. I just want to leave everyone with one final kind of stat. Essentially, we have something like $115 billion, $120 billion in spot Bitcoin ETFs today. If you compare that to the total market cap of Bitcoin, the total market cap of Bitcoin is $1.8 trillion. So spot Bitcoin ETFs essentially represent 6% of Bitcoin's market cap, which is a significant sum, right? And
it sure is.
Yeah, and I would predict that's only going to grow over time, right? In the past, the only way to buy Bitcoin was through crypto exchanges or holding the private keys on your hardware wallet and things like that. Now it's just so easy to go to your brokerage account where you already own stocks and just buy an ETF. So I think given the ease of this method of buying ETF, it's only going to become more and more increasingly the preferred way to buy Bitcoin. So I could see that 6% eventually becoming 10%, 20%, maybe even 50% one day. Who knows?
Hey, Simi, let me just ask you real quickly, what do you think is going to be the next crypto that is approved as an ETF?
I think it's got to be Solana. I've been hearing a lot about Solana ETFs potentially launching. And that is, if you look at, market cap and volume and things like that, Solana is the next most actively traded crypto token after Bitcoin and Ether. So I expect to see that. Another one people have pointed to is XRP. That actually has a slight higher market cap than Solana, 133 billion versus 93 billion. But XRP, a lot of those tokens are owned by the Ripple Foundation. It has a huge influence over that project. So I don't see as much demand for an XRP ETF, though we could certainly see one of those as well in 2025. We'll see.
Cool.
Yeah. So I think this is a good time to move on to the next topic, which is bond ETFs. We've been seeing a lot of action here over the past few weeks. Kent, I know you wrote a story recently about TLT and how it's having kind of a rough start to 2025 because interest rates are rising. Can you tell us a little bit about that?
Sure. Yeah, just to give a little bit of background, this week or Wednesday, to be precise, the 10-year Treasury yield, which is a widely followed benchmark in the fixed income space, bond ETF space, hit 4.7%. A lot of analysts would say anytime that yield gets over 4.5 is problematic for all capital markets, so stocks as well. So once that reached that level, we're seeing say some of the key ETF benchmark, like the SPY and S&P 500 ETF going down as well. But that 4.7% matches the high of 2024, which was reached in April, and that level had not been seen since October of 2023. And just kind of remind everyone a little bit of history there. That's when the Federal Reserve finally decided to stop raising interest rates. So that was kind of the peak. And we're looking at the 5% point, which has only been reached twice or surpassed twice in the last 18 years. So that's a little bit of history there. So we're getting closer to that 5% mark, and we're seeing investors everywhere kind of panicking. And that's reflected in another benchmark or widely traded ETF, the iShares 20+ year Treasury bond ETF that anyone who follows this, a lot of investors, just known as the ticker TLT, that's down about 1.5% year to date. It was down 8% last year. and writing a lot about this ETF. This was supposed to be a capital appreciation play, and because interest rates and prices generally move in the opposite direction. So if you're a fixed income investor or really just a trader thinking, okay, I'm going to make a quick buck, falling interest rates, then prices are going to go up. Longer term ETFs and bonds, higher, longer duration, they're more sensitive. So you can make even more money on the upside with the price if interest rates are falling. Now, of course, we know now that didn't happen. Inflation is coming down, but a lot slower than everyone thought. And so that's still coming into play this year. So coming into early 2025, we have some of those same concerns. Just this week we had the jobs report, or the job openings, the JOLTS report coming out, and the ISM services report coming out. Both of them were inflationary. And then in the background, lurking, if you will, is what are some of the Trump policies going to do? Tariffs or the threats come out almost every day. And then tax cuts and possibly massive immigrant deportation. All those things are inflationary. So now the fixed income market, bond ETF investors are thinking, maybe I need to get out of this. And so TLT, their flows are coming out of the fund. Some of the ultra short-term bond ETFs, like the 0 to 3 year Treasury bond ETF, SGOV, flows coming into it because you can still get a 5% yield and almost as no downside risk. It's kind of like a proxy high yield money market account. So very interesting. If we weren't talking about the Bitcoin anniversary, that would be the biggest news in capital markets this week for sure.
Yeah. And, you're talking about money going into the ultra short. Another ETF I'm noticing money's coming into is JAAA, the Janus Henderson AAA CLO ETF. That ETF has seen inflows of $1.3 billion over the past month, and already has $700 million of inflows over the past, just since the start of the year. And I know I've written about these kind of CLO ETFs, and they're kind of floating rate instruments. So as interest rates go up, investors benefit from higher yields. So in addition to ultra short-term bond ETFs, which aren't interest rate sensitive, another option for investors worried about rising interest rates is floating rate bonds and floating rate instruments where your yields adjust up with interest rates. And that's, of course, the opposite of something like TLT, where you're kind of locked in. And if interest rates go up, the price goes down. The interest rate sensitivity is really high for something like TLT. So you only really want to be in something like that if you expect interest rates to go down, or you're using it as a portfolio hedge or something like that. So yeah, we'll see. This is really fascinating time for fixed income. I'm looking at the Fed Watch tool from the CME. I know, Kent, you look at that sometimes as well, to get a sense of what the market's thinking in terms of rate cuts. And right now, it's looking like they're only pricing in one rate cut at the most. And even there's only like 50% probability of a rate cut this year. So we'll see what happens with that.
Absolutely. That's definitely an interesting story to watch, and we'll keep covering it here for sure.
Absolutely. So, the rise in interest rates hasn't had a dramatic impact on the stock market, but investors have started to pay attention to what's going on in the bond market. I know stocks were kind of rocky towards the end of December, and even early this year in 2025, we haven't seen much in terms of gains in the S&P 500. Has kind of been consolidating down 3 or 4% from the highs. So that kind of raises the question, what should investors do in terms of their stock exposure? Jeff, I know you love to talk about buffer ETFs. This is an area for investors who are kind of worried about the stock market. They still want exposure to the market, but not 100% exposure. Can you tell us about these?
Yeah. Yeah, I do love to talk about buffer ETFs. I think you guys know that more than anyone because of our daily chats. But buffer ETFs, just for the uninitiated, are they're called that because they do put a buffer around the top and the bottom of a fund's performance. They typically have some kind of downside protection. There are two types of buffers on the downside. One is if it's let's say 10%, it will absorb the first 10% of declines of an underlying index, take the S&P 500, and then anything beyond that, the investor absorbs over the full year cycle. These have defined outcome periods. So if, for example, after 12 months, the S&P is down 11% and you got a 10% buffer, you get a 1% decline. The other type is a floor, which is you absorb the first 10% on your own, and anything beyond that, you don't suffer. So if the S&P is down 11%, you're down 10%. If the S&P is down 5%, you're down 5%. In exchange for this, they all come with caps, and the caps are based on the price of options, and that's based that price and that cap is based on the volatility at the time. Higher volatility generally leads to higher caps. So you might have 7% upside performance cap. So you can only gain up to 7%. Anything beyond that, you're SOL. These things are incredibly popular with financial advisors and investors in or near retirement. Thus, the popular moniker "boomer candy." They call them boomer candy because they're being sold like candy to older investors. And these things are getting really, really creative. Calamos came out with one that's putting 100% downside protection on Bitcoin ETFs in exchange for a 10% cap on the upside. Allianz Investments just came out with one that's designed to run perpetually because it's a fund of buffer ETFs. Again, you got your cap you got your downside protection and your cap on the upside. My issue with these things, and I've kind of written about this and talked about it, is the average expense ratio of these things is 78 basis points. Okay. That's 78 basis points for exposure, protected exposure, granted, to an underlying index that you can get for about 3 basis points. So I'm asking people, financial advisors, I guess, what's the point of putting someone in an ETF that is giving you lots of protection on the downside and capping your upside for that much money? To me, it's like, do you really want to be maybe you should be in some of these fixed income instruments or something like that. I don't know. I mean, Kent, what are your thoughts on buffers? You probably talk to people that are nervous in these markets right now.
Right. Yeah. I mean, I don't have any clients with them now, but some are asking about it. They read the Wall Street Journal or ETF.com and they're asking about it. Excuse me. But yeah, I can see some advisors maybe thinking, okay, if I can't beat it, join it. So I'm going to recommend these funds. But it kind of reminds me of index annuities, where they're giving you a guarantee of sorts, and so they may have some concern that clients are going to go elsewhere. But yeah, I kind of understand it to a degree where they're trying to have some nervous clients and they want to give them something. And again, personally, I don't recommend them, but I can see the concern of retired investors, and they can remember 2008 to 2009 when the S&P 500 dropped 50%, and so that's still fresh on their minds because they were in their 50s or whatever at the time, maybe, and so that fear is still there. So I can see how they can be popular. I can see why they don't mind paying the expenses for it. But I'm with you. Advisors should do their job and manage the risk and explain what the risks are.
And I mean, the thing is, they seem so harmless, and I guess they are harmless, but there's a suitability factor to be considered here, I think. Like the Calamos one, for example, 100% downside protection on Bitcoin, but a cap of 10%. Okay. We're talking about an asset that has gone up more than 100% over the past 12 months. If you're thinking you're getting exposure to Bitcoin with a 10% cap and no downside protection, you're really not. You're just getting potential, probably 10% upside.
Yeah.
I mean, it's Samit, what do you think?
At that point, it's not even a Bitcoin ETF, right? It's Bitcoin.
Right.
Like, like you said, you're gonna get 10% if Bitcoin goes up 10% or more, but if Bitcoin goes down that year, you're gonna get zero. So that's kind of the trade-off some of these ETFs are making. I'm looking at Innovator's homepage right now, and they're highlighting this ETF called ZJAN, and it's one of those 100% downside protection ETFs for the stock market. It gives you 7.5% on the upside potentially, and it
Right.
caps your downside completely. So the way I see it is it's a trade-off, right? You can go into a money market fund right now, make 4.5% guaranteed. But if you buy an ETF like this, you can potentially make more than that. You can make 7.5% if the market goes up by that amount or more. But if the market goes down, you're going to make zero. So you're kind of trading off, guaranteed 4.5% for the potential for 7.5%. So you kind of have to make the calculation. Do you think the stock market is going to go up? Usually it does go up, right? The S&P 500, I think, goes up 3/4 of all years or something like that. But there are times when the market goes down, and in those cases, you're better off in a money market fund.
Yeah, I mean, that's the thing. I mean, the S&P was up roughly 25% the past 2 consecutive years. That's not to suggest that it's going to happen again this year. That's not to suggest that it won't be, a big down year for the S&P, but kind of the odds are your favor with the upward bias of the equity markets. And I mean, you can't deny the popularity of these buffer strategies. They're over $46 billion in there. That's compares to 35 billion a year ago, and I think 200 million in 2018. So these things are being, I think, sold. They're comforting. They're simple to understand. They're easy to sell to clients. You can't blame the issuers for coming out with these things because they're just investors or advisors are so hungry for them. But I'm wondering if they're being oversold. That's my only question. I mean, when you start putting you're putting something as volatile and potentially, explosive performance as Bitcoin into a window of 10 percentage points, I'm like, I don't know. I don't know. I mean, if you're that afraid of investing in Bitcoin, that you're going to narrow your potential to 10%, you can get yourself a money market fund and get halfway there.
Yeah. And at a certain point, obviously these products are just proliferating. We're just seeing so many flavors of these ETFs. They're just becoming so complicated, right? You mentioned that the Bitcoin 10% one, and then you have to compare that one to the S&P 500 versions of that same product, like the ZJAN I just mentioned. The Bitcoin one has a 10% cap, right? This S&P 500 one has a 7.5% cap. But which one is more likely to, get you that return? Is Bitcoin more likely to go up over the next year, or is the stock market more likely to go up over the next year? So you kind of have to make that calculation in your head. Just so many things to consider, and it's hard to keep up with this space. It's just constantly new products. Well, I think that's a good place to end it. I want to thank all our listeners for tuning in to Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or you want to share your thoughts, join the conversation with us on X. Our handle there is ETFCOM. Catch you next week.